All right, guys. So, obviously, great week, short week, few trades here and there, nothing too big. And obviously, like I preach all the time, quality over quantity. And I did see some reactions the past couple of weeks of how you guys wanting to trade or how you guys do trade in general. And the first thing I want to kind of start talking about too is risk to reward. And the second thing I want to talk about is the market psychology behind the candlesticks, behind the price action of how we trade and how you should familiarize yourself before you get shaken out or before you get unsure of when you should collect profits or scale out. But whatever it is, we can go ahead and dive into it and what I think that you guys should kind of start looking into while you guys trade. So, like I said, first is risk to reward. Okay. And day in, day out, I always tell you guys to go in a larger time frame, right? And I tell you guys to do your top-down analysis. Obviously, we're checking out NEO right now, NIO ticker. And I am on the daily chart, meaning each of these candlesticks are 1 days of action. Okay. Now, from this chart, like I said, you always have to do your top-down analysis. You set your support and resistance levels, right? And it's very, very simple. I don't want to, go too detailed in that, but of course, find many points of where you find sellers being very strong, right? One, two, a bunch of rejections here. So I left that marked. As soon as it flips, I do suspect that this will be a level of support if it ever does fall back down, and I do suspect a bounce. Nonetheless, mark those areas, leave those areas in your charts as you guys trade, even on a smaller time frame, because they are going to be critical as you guys trade and look at the charts on a smaller time frame. Now, going into the risk and reward factor that I want to talk about, guys, NEO is going to be the perfect example. Okay, there are multiple ways of how traders kind of gauge the top-down analysis and use it on a smaller time analysis or smaller time frame on how they execute their trades. Now, do you guys remember when we first traded NEO, we caught this wedge breakout, all right? Right about here. Okay, we saw the wedge breakout. We wanted to trade to the upside, and we did catch this move, right? We took it on as, I think, a multi-day swing. But nonetheless, what you should have realized when we took this trade on of how we took the chart pattern breakout was that the entrance of our entry could and should have been a tight stop loss to either invalidate and then just be done with the trade, right? Meaning if we entered, let me go in a little deeper in. If we entered on this break, right? Let's draw a little $35 exact, also a psychological level, right? We could have used, a 1 to 2% stop loss from that risk to the potential reward, right? So from our entry, we did not know if NEO was going to blast off to the upside or not. We do know that based off probability from this larger chart pattern, a falling wedge, that the upside potential is definitely greater than the downside, right? Simple probability, simple statistics, and that's how we should be trading, okay? Meaning, if I'm going to enter here, this is what I'm going to risk before I exit the trade and say I'm wrong. However, the reward is obviously, in hindsight, let's just say we don't see this, right? Obviously we do, but if this was not here and we took on this trade, right? We entered here, we wanted to use this as a mental stop loss, 1 to 2% under your entry, right? So obviously this is going to be our risk, and our reward is pretty much maximum, right? Maximum potential could go to $100, whatever it is. As long as you're trading this same way, and you're identifying your game plan this exact same way, you already have your entrance, you already have your potential exits if you are wrong, and you do need to start following up to see where your potential exit is, right? And like I mentioned before, exits should be based off what your top-down analysis is. That is more conservative. That's the reason why I have these price points on my charts prior to, me trading NEO if I didn't have this information. Okay, so that's one example using top-down analysis to trade in a smaller time frame. to kind of picture the risk and reward. Okay, if let's just say you did not do your homework, which obviously is a red flag, you need to identify yourself as a day trader to know when you want to exit and when you want to enter and exit. Let me share my other screen. Okay. And I don't want to reiterate too much, but obviously the 3 levels, like you guys know, of when I trade is previous day's close, which is my white line, my pre-market low, which is the red line, and my pre-market highs, which is the green line. Okay. As a day trader, right, I am still trading the same way I've been looking at on the larger time frame, right? So let me just show you that chart again one more time. Move this out of the way. So again, let's say we're going back into NEO, and this is what we see on the daily time frame. We saw this larger trend wedge breakout. We wanted to see if we can break out even higher from this, and if it's going to validate to the upside, which, you know, by textbook, right, it probably is. The probability is probably like 75 to 25 that it's going to shoot up to the upside, which it did. Now, from that being said, you go back into your smaller time frame, okay, and you look at it, right? Obviously, you're just missing out on all these price levels that you marked on your time frame. You obviously do not even see the falling wedge, right? But what you do notice is that, you know, like this price point right over here, 42.11. I marked it on my top-down analysis. I know that this could be a potential risk to reward status if, let's just say, NEO dumped here, right? Meaning that I'm still in the upside trade already, but this could have been a potential stop loss or profit target if you're trading to the downside, right? But zooming out, right, and looking forward, and as a day trade, right, you will always notice that these levels, like I said, the previous day's close, the pre-market highs and the pre-market lows are going to stay consistent, where you are going to follow the broader market or the broader trend of a continuation pattern, right? What does that mean? That means what we like to trade as when we are breakout traders or breakdown traders, whatever you like to call it, is we like to see these break out and have continuations to the upside, meaning it makes higher lows, right? Higher lows, higher lows, higher lows. Okay. And going to a higher reward potential, right? Let's just say here, let me make this into a 5-minute chart, so it's a little bit more clean. Let's just say we're trading this right now, right? We don't see the dump yet, right? But we are seeing from a risk to reward standpoint, we know that we broke off of pre-market highs. I like to enter off of that. I'm watching the SPY broader market as well. It is skyrocketing at this moment. So meaning from this chart pattern squeeze, the upside potential, again, based off probability, is to the upside. Now, as a trader, you need to identify your risk, your tolerance, your risk level of tolerance of how you want to trade this. Some people, they don't want to risk as much, so they use the pre-market highs as their exact entry and also exact stop loss. Meaning if we blasted off here, which we did the first 5-10 minutes or whatnot, and then we sold back down and then it triggered this stop loss, they would have been out the trade. Okay. Of course, that's not necessarily how you want to trade, because when you guys are traders, you guys want to give your upside more potential than your downside. So meaning anytime I like to enter a trade, I always have a mental stop loss of 1 to 2% if I don't have a price level or a you know, an important significant level like the previous day's close in my benefit, right? So from this, when we enter this trade to the upside, obviously as we trade up and up, your risk factor becomes greater, right? Because now that from you entering here and you're making money as you're going up, the reward potential is slimming down, right? Less and less and less. And your risk potential is getting more and more and more, right? So as that kind of goes into effect, right? And this kind of goes to with textbook status and whatnot, you know, the height of the chart pattern of the breakout should be the price target of the height of where you should probably start scaling out, or probably where you should just collect profits in total, right? At this moment, obviously, when we swing trade this, we entered last night, so we've been or the day before, and you know, we already had a massive run, right? So if I look at it from a risk to reward standpoint, right? Obviously, we entered, let's just say on average around right here. Okay, previous day's close. Okay. Now that we had this huge after hours and pre-market run up where we opened at, my risk potential is much larger than my reward potential. Does that make sense? So the smaller the time frame, obviously you're not going to get the bigger picture, right? If we're looking at it on the larger time frame, yes, you can kind of compare yourself where you're entering, where you're going to exit. For one, right? And then a lot of you guys, if you're in Neo right now, you're not going to like what I say. But going back into my larger time frame, from a risk reward standpoint, from that, here, let me zoom back out again, from this chart pattern breakout, which what triggered the trade entry for us, we are technically risking more, right, than what our potential reward would be, right? Because now we're trading right here. We technically, if you wanted to go zoom back out and say you entered here and you're writing this whole thing, I guarantee you should probably just collect profits. That's a massive run. Leave one runner if you want and you wanted to risk it. Again, it's how much you can stomach as far as risk tolerance. But based on a top-down analysis on a larger time frame, if you were to enter here, if you were to enter off this breakout, off this breakout, off this breakout, again, your reward is not going to be as much as it was when you entered here. So from a smaller time frame now, we did just enter again to the upside, playing that pre-earnings run up, which you can see on the charts right now. They do report, I think, on Monday. It is still a little bit more speculative. The probability of the trade to the upside now is significantly less than it was before, right? Obviously, when we entered here on that swing trade to today as well, it's definitely less. So from a risk reward standpoint, right, from a probability standpoint, you're probably not even 50-50. Maybe you might be even more to the downside. However, we are still trading a potential catalyst, right? And of course, we are also looking at many different larger time frame indicators, such as the 200 moving average, which when it does break and it does retest, it is very bullish. So there are signs that an uptrend is still concurrent in Neo. However, I just want you guys to understand how you guys should start looking at these charts. Okay, you shouldn't have a thesis and say, oh, I'm very bullish Neo, and just buy calls blindly, right? You need to trade like a robot, trade like you're looking at it from a statistical point of view, right? You know, we had a 3-4 week run up, and now we're just looking at a smaller time frame. Yes, Neo can still run, right? Can still go a lot higher. However, the likelihood of that, you know, continuing to go up is much more smaller than it is to come back down and retest, right? But again, if you're a scalper, right, looking at it from a larger time frame, having these price points, having all of these significant levels on your charts as you trade, especially as a price action trader, will definitely help you. A criteria that a lot of people ask too is, hey, you know, why do you enter here? Why do you enter there? And most of the times my answers are the same, because that's my edge. That's the way I trade. That's the way I've been trading. You guys seen it. When it hits a certain price point, my buy zone, it's not like I'm entering blindly. I'm still doing my due diligence, right? I still have a game plan set for when I actually profit or when I actually fail, right? But as a scalper day trader though, the main criteria: break a pre-market high. Always look at your SPYs, your indexes, your QQQs, your /IMs, your DJIs, whatever it is. Follow those movements. If we have the both continuation to the upside, like I said, probability, you're probably like an 80-20 probability to the upside. Now, from where you can actually take profits, and let's just say, you know, you got into the trade, and Neo is a perfect example, right? You got into the trade, you got greedy, you never collected any profits, you held through this huge sell-off, and it even went below, and you got chicken out, and you sold for a loss. You need to go back into the trade and review these trades, right? You need to understand, look, this was a chart pattern breakout. You actually caught the move to the upside, but you never collected profits. So this, again, it could be a risk to reward factor where you don't understand where you need to collect profits because you're a newer trader. But if you're a little bit more experienced, you know, again, the height of the chart pattern breakout could be and should be a conservative price target. If not, the second thing is having the average price movement per day per the stock could be a potential target as well. For NEO, for example, on average, if I go back into the larger time frame, the average movement of today's action is maybe $1.50, $1.25, right? And again, if you're looking at it on a smaller time frame and you knew that data as you were trading NEO, you knew it opened up higher already. If anything, the high for the day, the break off previous day's close with what the high of what it closed at was $1.60. So that average has already been hit. Your price target for where you should already collect profits or at least start scaling out, right? Leave some runners if you want, should have already hit. Okay. Let me know if that makes sense from a risk to reward standpoint. And we could do another example too, actually. Let's do like, let's do like AMD, right? I mean, AMD absolutely monster day, or we could even do NVIDIA, right? But here, let me show you this. So AMD, right? Again, much harder to gauge because we're trading at all-time highs. You really don't have any historical price points to kind of go through. You're really just basing it off of what momentum is going to be for the day, right? For AMD, trading all-time highs, you already know that you want to be a little bit more cautious, right? You're just managing your risk. Going into a smaller time frame now, looking at it from AMD. First, 5, 10, 15, 20 minutes or so of market open. Probably didn't want to touch it, right? Again, there are some traders out there. There are a few in the group as well where they use these particular price levels, right? Like I said, pre-market low, pre-market highs. They might be range traders. They like for the bounce off the low. So in a way, they buy the dips. All right. And from the dip bought, they like to trade it to the pre-market highs, collect profits in and out, done for the day, whatever it is. Right. However, for AMD's sake, right, for a breakout trader like myself, I like to make sure that they do break out in either directions. Right. So either break out, retest, have that continuation up, break down, retest, have that continuation down to make lower lows or higher highs. AMD, again, trading all-time highs, a lot harder to gauge how it's going to move, especially when you have no data to be involved with. But just based off of just how we looking at this momentum play, you can see that this day's action was simply beautiful. Broke, right? Made higher lows. Broke this. Here, let me draw the actual price point for these so you can see. Right. Mark these price levels as you guys trade. Broke, make higher lows, broke high of day. After break of high of day, it validated, right? It validated as a level of support for the day. Of course, you don't have to leave this level. Actually, I take that back. You could leave this level since it's trading at all-time highs. You don't really have any other levels to kind of look at. But leave this price level there for future sakes. If it does bounce there again, you know that this is going to be a strong level of support or resistance, as you guys trade this name again. But looking at the price action, like I said, if you're looking at it from a risk to reward standpoint, you saw that break. Okay, that breakout. It was a weak breakout, right? We're midday, volume's weak. It is what it is. Again, you should still be cautious because we're trading at all-time highs. However, from this breakout and that retest, and now we're holding as a level of support, intraday price action as a day trader, your thesis should be trading this to the upside with minimal downside, right? So this is your risk, right? And this is your reward. Okay. So as a trader, that's how you should be trading, right? Again, you shouldn't be like, oh, AMD, I'm bullish, semis, chip shortage, I'm gonna buy calls. That makes no sense, right? If you're a day trader or a swing trader, this is what you need to look for. Yes, you have a bullish thesis, so you want to trade AMD to the upside. That's fair enough. You want to trade calls, you can leave your calls here in your active trader. That's fine. You only want to trade the upside because you have a bullish thesis. But from that bullish thesis standpoint, you need to understand certain price levels, certain breakout zones, certain hold zones, and how that risk to reward factor is going to benefit you so that you can minimize your risk if, let's just say, you are wrong, right? If you're caught holding the bag and you don't have a game plan saying, okay, this is my risk, so this is where I'm going to exit if I am wrong, right? If you don't have that and it dumps like Neo and you get shooken out and you lose money, or even worse, let's say it's like a piton where it just freaking free falls, right? You know, then you're pretty much gambling at that point. You need to understand from a risk to reward standpoint that the risk is minimal, the reward is much greater. Therefore, I am going to take this trade. Okay. And that goes again, like I said, for a downside play. If let's just say AMD fell, it retested down and it's making lower lows, you can buy puts, same concept. You, if anything, instead of just this, let's just see, let me back up really quick. Let's just say this is AMD's action after. It failed, invalidated, retest, and it made lower lows. Okay, I'm gonna try to make this clean. Ignore this blue line right up here. Ignore all of this action. So same exact concept. Okay, you saw it holding up as a level of support, right? After that breakout intraday, you think it's going to trade to the upside. This is your minimal risk and this is your potential reward, right? Now you're going to enter calls. You enter calls and it breaks those calls. You get stopped out. That given moment when it hits your mental stop loss or your stop loss in general, you should tell yourself, I'm out of the trade no matter what happens next. And again, a controlled loss is much better than you know, going blindly, doing this and that. It makes no sense if you trade like that. Now, let's just say it did fall out and you bought puts because you saw that breakdown and you're like, okay, it broke down, it failed that level of potential support. Now I think it's going to make lower lows. Same thing, okay? Your risk is going to be up here because you're buying puts now. So if it does bounce back up, right, and fakes you out and shakes you out, you should be out of the trade. But your reward is to the downside again. So that's how you should be looking at all of these trades, no matter what. Yeah, and this price action is very clean. I mean, I wish I wasn't focused on, you know, Neo or something in the morning just because we swung it. So it's like, okay, my main focus is Neo, right? But AMD, NVIDIA, Jesus Christ. Beautiful place. NVIDIA is freaking monster. But again, NVIDIA, AMD, for those who are, you know, dwelling on, oh, I could have made more profits, don't be. It's all-time highs. Anything could have happened. You have pretty much no data to go by. Yes, you could have left a runner, right? But hey, everyone's risk tolerance is different. Everyone's experience level is different. For me, just to be out, save some mental capacity, on to the next one, you know, just forget about it. Anyways, yeah, moving forward, let me